Tonight, as I mentioned, we're going to be talking about understanding and being able to trade consolidation. These lessons, especially this week, the sequence that we're presenting them in is for the eventual ability. We want to have the ability to be able to trade fundamental announcements effectively. And in the next segment, we're going to narrow down, we're going to focus in on the non-farm payrolls announcement. But for now, let's talk about the different types of consolidation that exist. I've shared the document that you're looking at for reference. I've shared this inside your handouts section on the control panel of GoToWebinar. So if you click on your control panel, you'll be able to find the handout section. If you don't know what I'm referring to, your control panel should look something like this. All right? Control panel should look something like this. If you can't see the entirety of the control panel, then you should at the very least be able to see this thing. Right? And if you click on the red arrow in the top corner up here, it will reveal the rest of the control panel. So in the control panel, there's a handout section, and inside that handout section, if you click on the plus icon, it will reveal the trading consolidation worksheet that I've created. Okay? Let's talk about identifying consolidation. When it comes to identifying consolidation in my charts, I forgot to reopen them, or they just didn't reopen. When it comes to identifying consolidation, this is one of the, when it comes to spatial aspects, trading consolidation is up there along with the most difficult. The main reason is because traders try to make consolidation way more formal than what it actually is. Right? Yesterday, we talked about how to identify support and resistance, right? We talked about resistance being higher highs. We talked about support being lower lows. But when we're dealing with consolidation, consolidation does not operate on that same wavelength, right? When we're identifying resistance or support, we're working specifically looking for a higher high, a wick that's a higher high and a higher high and a higher high. When we're looking for support, we're not doing that. We're looking for a lower low, right? When it comes to identifying support and resistance to the consolidation range, we're not looking for any specific higher high. We're not looking for any specific lower low. Now, before we get into this, does anyone have a currency pair or time frame that they would like to suggest, or both? The information that we're going to be discussing here is not necessarily time frame specific. For the different methodologies on how to trade it, I'll let you guys know the different time frames that are appropriate to look to trade the different types of consolidation as we go along. Currency request, pound Swiss. Okay, so do you have a time frame that you would like to use? New chart, pound Swiss. Okay, 1 hour chart. All right, so we'll go pound Swiss 1 hour chart. First and foremost, when we take a look at the market, we've discussed in the past, you've learned in the Ultimate Traders package that the market does not move in straight lines, right? What the market tends to do is wave. However, periodically between these waves, we can see areas where the market is not moving in the general trend direction, right? Where the market just kind of pauses for a little bit. These areas are consolidation ranges, right? Where the market is not consistently moving in the direction of the trend, not making higher highs, not making lower lows. It's just kind of hanging out, right? Doesn't really go anywhere. Eventually it breaks out. Right? These are consolidation ranges, and these are just some of them that I'm pointing out here on this chart. Now, when we learn about consolidation in the Ultimate Traders package, we get a deliberately oversimplified explanation. All right? When we learn about consolidation in the Ultimate Traders package, what we are presented with is something that looks like this. We get two lines, and we get some lines that represent the market going up and down between, right? And this is representative, this is accurate. This is representative of the behavior of consolidation. What this is trying, this is deliberately oversimplified, a textbook explanation of the market oscillating between resistance, resistance and support. And that is in essence what the market is doing. It's oscillating between a level of resistance and a level of support. However, when we look at a live market situation, the live market doesn't actually move this precisely, right? There is some order in the chaos, but the live market does not necessarily return exactly to the same price point every time it visits resistance and return exactly to the same price point every time it visits support. Instead, what it does is something like this. A more realistic example would be if we had resistance. Actually, we'll draw what the market actually does first, right? You may have some real aggressive movement followed by some pullbacks like this, and then the market may just go whippy nasty for a bit and come down. Very aggressive dip perhaps. Oh, there's that question box in the way. We'll just put this down here. All right? So we may get market coming back in here, doing something like this, right? Overall, we can see that this market isn't necessarily consistently making higher highs and higher lows, right? This market is not consistently making higher highs, higher lows. Instead, this is sideways. If the market is consistently making higher highs and higher lows, it is trending. When the market is not trending, the market can only do two things, right? It can either trend or it can not trend, which means it's sideways. So if the market is not consistently making higher highs and higher lows, or lower lows and lower highs, we are sideways. And the way that we identify consolidation is with a single line to identify an average level of resistance and an average level of support. This is not formal support and resistance. So I would not simply, this is what new traders that are learning consolidation, a lot of the times, what they will do is they're constantly hearing, highest high, lowest low, this, or A, B, C, Ds, or identify the high of this, identify the low of that. And so what they will do is they will identify the highest high and the lowest low. They can, on a spatial level, perceive that the market is not consistently moving in one direction or the other, right? That is not the challenge. The challenge is properly identifying where the market is actually forming resistance and support. In this situation, this would be inaccurate because I am not paying attention to what the market is actually doing. Right? These are extremes that the market has only been able to hit once in this example. Right? When you look at the overly simplified example of the Ultimate Traders package like this, what you will notice is although it's returning to the same level of resistance, returning to the same level of support, what this is intended to teach you is that it's doing it consistently, returning to the same area, consistently returning to the same area. Right? That's what we're shooting for when we're looking to identify consolidation. So with a single line for resistance and with a single line for support, I'm going to aim for that. I'm going to not be afraid to be conservative, and I'm going to come on in here and try to get as many touches as I can to a single line for an average of resistance. Right? And I'm going to do the same thing for support. I'm going to come on in here and I'm going to try to get an average, right, where the market seems to touch consistently. Right? This would be my consolidation range. This makes sense? Any questions on this? Okay. So on this chart then, let's go ahead and let's do a spatial exercise. Let's, to the best of our ability, I'm going to bring certain segments of the charts into visibility, and I want you, to the best of your ability, identify consolidation ranges, right? There's no right, wrong answer, right? Just to the best of your ability, see if you can visually spot the ranges. I'm going to leave this up for a few moments, and then we're going to go through. I'm going to identify the consolidation ranges. Right? If you have a chart pulled up, even better, and you want to draw them out, by all means. What I typically use to identify my consolidation ranges is I'll use the horizontal line tool. Either the horizontal line tool, or preferably I use the parallel line tool, because I can identify, I'll draw like this, let's say for an average of resistance, and immediately I get a line of the same length. It doesn't just infinitely extend like a horizontal line will do, but I'll get a line of the same length, and I can kind of just identify the range, place it for the average of support. Right, so preferably I'll use these. Okay, so with this amount of time, we should have been able to just kind of skim through the chart and identify a few consolidation ranges. I'm going to point out a few here. Right? We've got an area right here where the market is not consistently making higher highs, higher lows. So we got an average of resistance right around there, average of support right around here. I'm not hunting for any particular candle wick or body. Right? I'm just trying visually to represent the oscillation, the bouncing movement back and forth between an average price of resistance and an average price of support. Right? Same for this. Period of indecision, or a period where the market did not consistently make higher highs, higher lows. Right? So I got an average of resistance right around there, average of support right around here, and the market eventually broke out. And we'll talk about breakouts in a minute. Right? Sideways. That's too high. Okay, average of resistance, average of support, average of resistance, average of support, consolidation. Right? Anybody feel like this is beyond their spatial ability? Knowing now what it is. Right? Shouldn't require too much effort. Just a period of indecision, that's all it is. I usually get asked, wait a minute, how many candles will it take in order for me to identify a consolidation range? And that, honestly, there is no, quote, minimum amount of candles. I would say at least 2 if there were, but again, it's just a spatial thing. You either see it or you don't, right? If you see the market return to the same point of resistance, return to the same point of support, and not be able to progress beyond that, you can immediately start to draw your consolidation range. Usually it takes a little bit for you to be able to draw it, right? So right here with 2 candles, I would not be able to say, oh yeah, there's consolidation. I would kind of want to see this market come back down, see how it didn't progress to make a higher high, but it didn't really go down to make a lower low. Consolidation. Right? There's no set amount of candles per se. You just kind of start to see it. Any questions on this consolidation? How to identify the consolidation ranges? Anybody feel uncomfortable with this? It's extremely important to be able to identify it and identify it accurately, so to the best of your ability. You don't want to make the mistake of falling in the trap of identifying just the extremes, because if you fall in the trap of identifying the extremes, it's going to make trading consolidation difficult. It's going to make it very difficult to do it effectively. Okay, no questions. Perfect. So let's reference then the different types of consolidation. There are several different types of consolidation, and in the sheet that I've shared with you all, they're written. The first type of consolidation that you're going to run across is small consolidation. Small consolidation consists of sideways movement where the distance between support and resistance, your average or informal levels of resistance and support, average support and resistance, is less than 150 pips. Right? So if I notice that the market is not making higher highs, not making lower lows, and I put my lines, and I measure the distance between those 2 lines using the ruler tool, for example, and I find that it is less than 150 pips, I'm looking at a small consolidation range. And small consolidation can occur and does occur on all currency pairs and all time frames. Consolidation will occur on all currency pairs and all time frames. Now, when it comes to small consolidation, if I notice a consolidation range and I note that the distance between my average of resistance and support is less than 150 pips, I am in a small range. I am in a no trade zone. I absolutely cannot trade this. I will not trade that consolidation. The reason for that is because if the market movement is that light, it's more than likely going to be very erratic, and there's not going to be enough time for me to be able to participate effectively. Right? So I am not interested in any consolidation ranges that are less than 150 pips. The only way that I can look to trade a small consolidation range is to wait for a breakout. Right? I'm going to look to trade the breakout. A breakout is when the market is actually leaving a consolidation range. So for example, right here, we can see that the market is not making lower lows, not making higher highs. And then the market manages to create a bullish decision candlestick formation that is closing more than 50% beyond resistance, the average resistance. Right? Same here. A consolidation range is occurring. The market creates a bearish candlestick formation that closes more than 50% below support. That is considered the breakout, the market officially leaving the consolidation range. And that's the kind of thing that I'm going to be looking for in order to be able to trade a consolidation range. It must be. I'm going to look to buy bullish candles that break above resistance. Right? If I get a bearish candlestick formation that breaks above resistance, resistance is like the ceiling holding the market inside that range. If I were to get a bearish candle that kind of pops beyond resistance, I'm not going to care about it. Because if it pops above resistance, that means it may be getting ready to move in the direction of the bulls. But a bearish candlestick formation is a signal from the market that the following movement should be downward. Right? So I'm not going to buy a bearish movement. Same for support, right? The opposite side of the same token. If the market is forming a bullish candlestick formation at support and the wick dips below or something like that, I'm not going to be interested in that. I'm going to be looking for a decision bearish candlestick formation to break and close 50% or more beyond support to consider that a breakout. Right? So if I encounter the breakout, any questions on the breakout? Right? Decision candlestick formation. Here's a decision bullish candlestick formation closing more than 50% beyond resistance. Here's a bearish candlestick formation closing more than 50% below support. Okay, so if I spot the breakout, I can look to trade the breakout. And I'm going to follow the same rules that I would with candlestick formations, except that with those candlestick formations appearing, for example, we've got this bullish candlestick formation closing 50% or more beyond resistance. I can look to trade this breakout. What I'd look to do is when the candle closes, I can look to enter in at the close of that candle, buying the market. My stop loss will be placed beyond the consolidation range. So if this is where support was for the consolidation range, if I'm buying, I'm going to go 10 pips below that, right, to 97, beyond the range. So if the market decides to come back down to retest support, it's probably going to come back into the range, and support of that range to help hold it, right, and I won't be stopped out. So I'm going to go beyond the range, 10 pips below the range. If I'm buying, 15 pips above the range if I am selling, right? And as far as my targets, where to get out, how do you identify where to get out when trading a candlestick formation? Anybody remember? How do you identify where to get out? In trading account. Exactly. Actual levels of support and resistance, right? Formal levels of support and resistance. So in this case, I would have been looking at a risk right here. Measure the distance between my entry price and my stop loss. I'm looking at a risk of about 63 pips. So with a risk of 63 pips, I would look for equity management. That makes sense, right? So if my risk is of 63 pips, 63 times 1.5, the minimum equity management taught in the Ultimate Traders package, gives me a total of 95, roughly 95 pips. So I would have to identify a higher high of resistance that makes equity management sense. I go back in time and identify a higher high that makes equity management sense, right? So I go for a higher high from my entry price. That's at least 95 pips away. Here's a higher high, 46 pips. I need higher than that. Okay, here we go, right around 100 pips. That is the first higher high that makes equity management sense. So I would be able to set my position to look something like this, right? And I'm looking to set up for the buy as the market breaks out in the direction of the bulls. There it is, makes a higher high. I can cancel and replace, follow my stop loss if I need to maintain the position, etc., etc. There it is, limiting out. Any questions on trading small consolidation? Effectively, we're going to be monitoring. If we see small consolidation, we can't jump in immediately. We have to wait for the market to give us some signal that it's leaving that range. But if it does, we can trade the breakout. Stop losses will go beyond the extremes of the consolidation range, the averages of the consolidation ranges, support or resistance. Okay, perfect. Right? We wait for the confirmation, closing 50% beyond at least, and then we can look to trade the breakout. This is when we're not expecting a fundamental announcement, right? Typically, if we see a breakout on any small consolidation range, rather on any time frame, and we're not really expecting any announcements to take place, then this is the strategy that we could look to follow. There is also large consolidation. The second type of consolidation is large consolidation. So same process, if I identify a range, and this usually unfolds on time frames of 2 hours or more. So if I am looking at a time frame of 2 hours or larger, and I identify that the market is not making higher highs, not making lower lows, then what I can look to do is draw out my consolidation range. And the next thing that I'm going to do is I'm going to identify what kind of consolidation range I have. Having done so, if I find out that the distance between support and resistance is greater than 150 pips, right? Greater than 150 pips, then what I'm going to do is I can look to buy at support and sell at resistance. So on a chart, let's go back to the charts. This is a 1 hour chart, so I would not be able to do that here. If I change this to a 2 hour chart, all right, let's compress the chart and see if we can identify some consolidation. Compress the chart, compress the chart, compress the chart. Aha, okay. Everybody see this period right here where the market was not really making higher highs, not really making lower lows? I can go ahead and identify a consolidation range here with the horizontal line. I can point out an average of resistance right around here and an average of support, let's say right around here. So if I measure the distance between those 2 points, I'll find that I have a consolidation range here almost 150 pips, right? Let's pretend this is 150 pips. If I find a consolidation range that is greater than 150 pips, and I can very easily remedy that, 150 pips or more, right? Find that consolidation range. what I'm going to look to do, that's why it's extremely important to be able to identify these accurately. The methodology is to look to buy at support and sell at resistance. If we've got at least 150 pips between these 2 points, every single time the market is getting ready to make a push toward, because that's what the market does in consolidation, right? What the market does in consolidation is oscillate or push between these 2 points. It pushes from support up to resistance, from resistance back down to support. Back up, back down, back up, back down, right? That's all it's doing, up, down, up, down, up, down. So as long as the market is not breaking out, we should expect that that movement is going to continue. And what we're looking for then would be opportunities to be able to buy at support, sell at resistance. So what we're looking for at support, if we see a bullish decision candlestick formation form at support, we can look to take the buy position. We enter in buying at the market close. Stop loss will go below the consolidation range, and we look to take the ride, look to limit out right before resistance, 10 pips before resistance. Right, should be on the sheet. Buy at support, sell resistance. Your stop loss should be beyond the range, 15 pips above or 10 pips below. And your limit target will be right before resistance or right before support. Okay, so I would take the ride all the way up, continue to hold my position. When the market hits resistance, I get out. If I don't see an actual breakout, I'm going to wait for the market to come back into the range. See how none of these candles were actually decisive candles, closing more than 50% beyond resistance. The market comes back into the range and gives me a bearish candlestick formation at resistance. I'm going to sell that, and I'm going to take that ride all the way back down to support. Hold the position until the market hits to support, or I get stopped out. Once I get limited out, then again, I'm going to be looking to see if the market is getting ready to leave the range. If the market gives me a bearish decision candlestick formation closing 50% or more beyond support, then I can proceed to potentially trade the breakout, right? Because that's what the market's doing. If we get a breakout, I can actually trade that. But if the market is giving me signals that it's, right, here's a breakout. At this point, I can look to trade the breakout. Right? In this case, that breakout failed. The market came back into the consolidation range. Bullish decision candlestick formation goes all the way back up to resistance. Bearish decision candlestick formation goes back to support, and again and again and again. So if I'm looking at least 150 pips between these 2 points, and I'm buying at support, selling at resistance, that's 150, 150, 150, 150. Right? It makes for a very nice way to be able to consistently capture profit here. Up and down, up and down. Usually what you will see me do is I'll identify consolidation ranges on the much larger time frames, daily chart, and then I'll come down to the 2-hour chart, which is the smallest time frame that I'm allowed to be able to trade this on, and look for that entry opportunity. All right, look to be able to participate on the smaller time frame. Any questions on this? The reason being because if I wait for a daily candle to close, right, I'll go ahead and turn on my daily encapsulation. Right, every one of these squares is 1 day's worth of movement. So right here at support, I got this tweezer bottom, which is technically a bullish decision candlestick formation that I could have looked to buy and be able to take the ride from support all the way up to resistance. If I waited for the daily candlestick formation to close, right, where we've got potentially, let's say we've got a decision bullish candlestick formation here on the daily chart. This square represents a day candle. If that's a bullish candlestick formation, I waited for that to close, I'm thinking about buying from here to try to take the ride all the way up to resistance. With the stop loss below support, my risk is going to exceed my reward. So most of the equity has already been chewed up if I wait for the larger time frame to give me the entry signal in this case, so it would be inequitable for me to look to enter in. So usually what I'm looking for is the information on the larger time frame kind of resting at support or resting at resistance, and then on the smaller time frame, I'll look to trade in that direction with better equity management. That's the name of the game. Does that make sense? Bert, excellent. Now, tips of the trade when it comes to consolidation, right? Because we saw this, right, where the market gave us a bearish decision candlestick formation closing beyond, right, support. If we looked to participate in this and decided to sell the breakout, the market did indeed come down low, but if we went to target a lower low, that made more equity management sense. Because if you're trading the breakout, remember your stop loss would have to be beyond the consolidation range, right, 15 pips above. So what the market actually did was, instead of continuing in the bearish direction, it actually came back into the consolidation range. One of the things that you can use to kind of help you qualify whether or not a breakout is legitimate, look at your stochastic indicator. Okay, add your stock RSI. Hang on, simple stock RSI, which we've created here on Analyst on Demand. We've just eliminated the %D, %D slow. I don't need that. Just nice and simple. Simple is best, right? So hang on, it's not showing anything. What's going on here? Just like with any position that you would look to get into, there we go. Refresh with F3, my stochastic has popped up. Just like with any trade that you'd look to get into, guys, look at the position of your stochastic indicator when the market is breaking a consolidation range. Because remember, your consolidation range is going to be based off an average anyway, right? So you're already kind of dealing with murky waters. It's not the clearest. We're not talking about actual physical, like formal support resistance, higher highs, lower lows, that kind of thing, right? We're dealing with an average. So, and your consolidation range is maybe slightly different from mine by a few pips, right? As long as you're not 50 pips or super wide, 10 pips, 15 pips, that's okay. You want to take a look at the position of your stochastic indicator when the breakout is occurring, right? Here's where the market made the breakout, or if you were waiting for a more decisive signal, boom, right? That's without any like shadow of a doubt, a bearish decision candlestick formation closing more than 50% beyond support, right? But look at the position of the stochastic indicator, right? It's what I'm looking for confirmation for this kind of thing would be the stochastic indicator either firmly in the overbought zone for a sell, or for a buy firmly in the oversold zone, right? You turning up. Because what the stochastic indicator does is keep track of wave movement anyway. So if I see a candlestick formation closing beyond resistance or beyond support, what I'm looking for is for the market to kind of, for the upcoming wave, the upcoming push, momentum, whatever you want to call it, to back the entry that I'm getting ready to make, right? So right up here, the market at resistance, actually right above resistance, but at resistance gives a bearish candlestick formation. We're looking at the market in the overbought zone. That's good because it's also indicating the market should be making a push down, right? So I would expect the wave momentum to be down. When the market's at support in the oversold zone, gives me a bullish candlestick formation. Again, I'm feeling more comfortable with these entries because I've got multiple signals letting me know the market should make a push in my direction, right? Everybody clear on how to be able to participate with large consolidation. Remember, if it's small consolidation, we're absolutely not looking to buy at support, sell resistance, right? We're just not doing that. Too small, too erratic. But if it's larger than 150 pips, we can look to buy support, sell resistance, buy support, sell resistance. As long as the market is inside the consolidation range, we have no reason to believe otherwise. Even if you're in an AOD boundary, right? Even if you're in an AOD boundary, remember that when the market enters into consolidation, it doesn't render the AOD boundary irrelevant in any way, shape, or form. But if the market is going to fulfill the AOD boundary, right, it's going to have to leave the consolidation range first. So deal with the consolidation range first. If the market manages to leave the consolidation range, then seek to trade the ABCD. Any questions on this? All right, perfect. So last but not least, we've got the big deal. Okay, and we're going to get into this. We're gonna beat this to death in the next segment as well because we're going to be talking about non-farm payrolls. But fundamental breakouts in anticipation of a major projected impact fundamental. Okay, when you are looking at the market with the expectation of a fundamental announcement taking place. What fundamental announcements tend to do when a major projected impact fundamental announcement takes place, usually we will see very aggressive movement on behalf of the market, right? So when you look at any kind of economic calendar, what is consistent, the economic calendars from different sites may look a little different, right? But what is consistent is the color scheme. And out of all the colors, even if the colors are a little different, when we're talking about a major projected impact announcement, we're talking about an announcement in red. The expectation is high. The expectation of movement is high. So when you see a major projected impact fundamental announcement getting ready to take place, we're expecting that to take place. We see the time when it's going to take place. Some calendars will even show us from where we are right now in time until that next announcement occurs, how much time there is left, right? Which is always nice. So if you see this and you've got a major projected fundamental announcement expected to take place, what we can look to do is set up for that announcement, right? Prepare to trade that announcement. The way that we would do that is as follows. You're only looking to do this on time frames of less than 1 hour. Since you're looking at time frames less than 1 hour, more than likely what you're going to be looking at is a small consolidation range of less than 150 pips. Right? Most likely, that's what you're going to be looking at. I have several workspaces. If you take a look at my workspaces, I have several of them that say a currency and fundy next to it. A currency and fundy. A currency and fundy. Right? These are basket workspaces that I've created for the different base currencies, right? Or for the different currencies the different currency groups that exist. So for example, if I take a look at my economic calendar during my trade session with you guys, and I see that there is a major projected impact announcement expected to take place, what I will usually do, instead of doing it on my actual charts, my regular charts that I do normal analysis on, I have this separate workspace and I have a collection of all of the currencies that concern that on the 15-minute chart. Right? You can look to do this on any time frame that is less than 1 hour. My preferred time frame personally is the 15-minute. It doesn't mean you have to use the 15-minute. Okay? So here's what happens. Prior to a fundamental announcement, right, and this was a previous setup that we did, but prior to a fundamental announcement, what you will usually notice is that the market will start to consolidate. And that's because educated traders always take a look at the economic calendars, and they are paying attention to when these announcements are getting ready to take place. So what they do is they will actually stop trading. They will close positions. Money gets pulled out of the market, and what the market starts to do is trading becomes very light. You will see these consolidation ranges start to form. Right? So in anticipation of a fundamental announcement, it is very usual to see consolidation, tight consolidation across all of the currencies concerning that currency that is going to receive the announcement. So if the Bank of Australia is getting ready to release an announcement, you should notice that all the currencies that mention the Australian dollar will more than likely start to consolidate. If the Bank of Japan releases something or is getting ready to release something major, you'll likely notice that the currencies that contain the Japanese yen will consolidate, right? And what we do in order to be able to participate, what we are expecting is that the market will break out of the consolidation range, right? But we don't know what direction it's going to break out in, right? Since a lot of traders are paying attention to this, when we're talking about fundamental trading, there is a very high potential to be able to capture a lot of pips in a very short amount of time, right? So the way that we do that is we straddle the market. We don't know what direction the market's going to go aggressively, so we will straddle it. Please note, we are not talking about a hedge here. A hedge is when you actually enter into two positions in opposite directions on the same currency pair. We are not talking about a hedge. I'm not going to buy and sell at the same time and wait for the market to, start going in one direction, because I'm not actually going to be making anything. I would have to be paying really close attention for every pip that I gain. If the market goes bullish, I'm actually losing a pip with the bearish position, etc. That's not what we're doing, right? In any way, shape, or form. A straddle are pending entries, and the market's going to have to meet the criteria of one of them to actually take us in one direction only. So the first thing that we do is we identify the consolidation range, of course. Okay? Identify the consolidation range. So once again, with an average of resistance, okay, for the last 2 hours or so, average of resistance, and an average of support. Make sense? Nice and tight consolidation range. I don't really have to sit here and measure the type of consolidation, because I know that I'm expecting a fundamental announcement. Right? So I'm not going to just immediately measure that. No real need to do that. Instead, what I'm going to do is, once I have my average levels, I'm going to look to place a pending entry buy 15 pips above the price. Right? So right here, my price of resistance is 84.31 roughly. I would go up to 46. And that's going to be my pending entry buy price. For my entry sell price, I'm going to go 10 pips below. So this is roughly at 19. I'm going to go down here to 0.9. Right? And the types of orders that I'm going to be using are the entry buy stop and the entry sell stop. Are there any traders in the room that do not know the difference between an entry buy stop and an entry sell stop? And an entry buy stop and sell stop, and an entry buy limit and sell limit. Right? There are several types of entry orders, especially when you're dealing with MetaTrader-based software, which is kind of an industry standard. And MetaTrader requires you to point out the specific type of entry. Okay, I've got a few traders in the chat box. All right, so here is the difference. And it's pretty popular not to know what it is, because the nomenclature sucks. All right, it really does. It's terrible. We didn't come up with it. It's just an industry standard, unfortunately. But what is it? That's what pending orders. I've got a few of these that I can share with you. Pending orders explained. This is a write-up on it, but I'm actually going to show you what these look like with an image. So I'm not going to open this up, but I will share it with you in the handout section. Pending orders explained. And then I've got a picture of pending orders that I've created, a little explanatory picture, which we're going to explore here. Open file location. All right, and I'm going to pop that in the handout section, and let's take a look at this. All right, so here are the different types of pending orders. Please note, all right, Bert, welcome. Came to the right place. Please note that the following refers specifically to entries only. What we're getting ready to talk about are just entry types. All right, so the nomenclature, the naming of these is terrible, right? Because they are named in a very counterintuitive way. But that's just what they're called. We didn't come up with the names, so we just kind of have to deal with it. I will do my best to explain to you what it is so you understand. The first set, what we're talking about right now, is the entry buy and sell stop order, usually used for breakouts of consolidation, right? An entry buy stop is an entry that is placed above the current market price. Right? So we're not actually getting into the position. We're placing an entry above the current market price. And the reason why is because we're expecting that if the market were to move, it's going to do so aggressively. And if it touches that price, we would like to be taken in, expecting that the market is going to continue to move aggressively, allowing us to capture profit at volume. All right, so as the market continues to push in that direction, we continue to make more and more profit. On the other hand, you've got the entry sell stop. Right? Entry sell stop is the other side of that coin, where we place the entry, pending entry, below the current market price, expecting the market is going to fall aggressively, hit that price, take us in, and continue in that direction, allowing us to capture profit. Does that make sense? Right? We're placing the pending entries beyond the current market price, expecting that we're going to be triggered in and continue to capture profit. Benu says, Will, your screen is blacked out. That is not good. It should not be. It should not be blacked out at all. Traders, can you see my screen? Okay. Okay. It's possible that when I clicked on full screen for this, it may have messed with GoToMeeting, which is weird, but I'll keep it this way just in case, right? So entry buy stop, entry placed above the current market price expecting to be triggered in and continue to capture profit. Entry sell stop, placed below the market price expecting to be triggered in as the market continues to fall. Okay, so any questions on the entry buy stop and the entry sell stop? Any questions on that? Okay, so the entry buy and sell limits are a little different. When we're talking about the entry buy and sell limit, this is effectively calling a high or calling a low, right? We're calling a high, we're calling a low. When you place a entry buy limit, you actually place an order below the current market price, but you're looking to buy the market. What you're expecting is that the market is going to retrace to that price, touch that price, trigger you in, and then turn around in the bullish direction. Right? This is used a lot with ABCDs. We have lives. As people first and traders second, we have lives. We have things to do. So I cannot always stay in front of my computer waiting for this market to hopefully give me a C retracement and the perfect opportunity with the perfect candlestick formation, yada, yada, yada. It's not always going to work out that way as much as I'd like it to. Right? So for those of us that lead busy lives, you may simply look at the market and say, you know what, this is an uptrend. I know that the market, as long as it doesn't take out the A, it should go on its Fibonacci way. And so I'm comfortable with the equity management required for this AB boundary. If the market were, for example, to come down to the 5.0, then that means that if I place my stop loss below the A, I'm going to be risking X amount of pips. And if I look to limit out at the D extension or 10 pips in front of the D extension, I'm going to be looking to go after X amount of pips. So that is within equity management standards. It's less than it's less than 5% of my account, 5% of my account. And since it's less than 5% of my account, the equity management is acceptable. I would be okay if this market came down and touched this price, took me in. All right, so that's effectively where I'm expecting my C. I would set my pending entry. If the market were to come down and touch that price, it would take me in a buy position, and I'm looking naturally to limit out a D or a higher price. If the market were to come down, hit that price and take me into a buy position and continue to dip down to a lower point, then I'm going to be losing money as the market dips down toward its deeper C. Of course, once the market starts to go beyond that, then I will join into the profit. Right? The entry sell limit is the opposite of that. If I'm in a bearish market, I would place my pending entry above the current market price,
Again, I'm expecting that the market is going to retrace, touch that price point, trigger me in, and then resume the general trend direction. So in essence, once again, when it comes to your entry, buy, and sell stop orders, I'm expecting that the market is going to hit my entry price and continue in the direction of the bulls or continue in the direction of the bears. If I'm using an entry buy or sell limit, I'm actually expecting that the market is going to retrace to my entry price, take me in, and turn around, resume going in the trend direction. Any questions on what we've just discussed? All right, Zachary, perfect. Everybody clear on this? Bert, you're very, very welcome. So when we're talking about trading fundamental announcements, again, we're simply going to be talking about using pending entry buy and sell stop orders. So in this case, I would set up those orders, right? In this example, I would set up those orders. And the way that it's going to work is these orders also, I've put a slash here because these orders are not only going to be our entries, they will also serve as the stop loss. And what I mean by that is if the market were to rally aggressively and go in the direction of the bulls, right, I've set this up so that this is my bullish entry price. What I'm going to do if that does occur and I get triggered into a bullish position, I'm going to use what would have been my entry sell price as the stop loss for that bullish entry. All right, so if my bullish entry gets triggered, I will use the sell price as my stop loss. So I've killed two birds with one stone. I've identified my entry and I've identified my stop loss. Same thing if the market were to dip in the direction of the bears and trigger my entry sell, then I'm in the market selling, and what I will do is I will use my entry buy price, what would have been my entry buy price, as the stop loss for the bearish entry if the market goes bearish. That make sense? So one way or the other, what I've identified are entries and stop losses. No matter what this market decides to do based on the announcement, I'm looking to be taken in and I'm looking to participate. So if that's the case, that means one way or the other, the distance between these 2 points is my risk. So I'll measure that distance and I'll identify what my risk is. Based on the risk, right here I'm looking at a risk of roughly 37.5, so 38 pips. I will take the risk and I'm going to look for minimum equity management as taught in the Ultimate Traders Package. So 38 times 1.5 absolute minimum equity management. So I'm looking for a minimum of 57 pips. To identify my limit targets, you are going to use formal support and resistance. So from the entry price, I'm going to go back in time and I'm going to identify an exit for the bulls, a higher high of resistance that makes equity management sense. And I'm going to identify a lower low of support from the entry price that makes equity management sense, so at least 57 pips away. I will more than likely have to compress my charts and identify my lower lows. If you're at current, right now we're not at current, but if you're at current, you can use your smart support, smart resistance tools, right? But in this case, we'll do this manually. So from my entry price right here, here's my first lower low of support. That's about 20 pips away. Can't use that. Here's my next lower low of support, 2 to the left, 2 to the right. That's 31 pips away. Can't use that. Next lower low, 54 pips. Close but no cigar. I'd have to go for the next lower low support, 2 to the left, 2 to the right, about 63 pips away. I would go ahead and set that as my bearish limit. Right? First lower low support that makes equity management sense. That's going to be my bearish limit. And I do the same thing for the bullish part, right? So I'm just going to throw a line up here. We're going to pretend like I actually did the work because I'm running out of time. All right? So now what I'm going to have is I'm going to have complete entries for both directions. I have an entry buy price, a stop loss, and a bullish limit that I'm looking to target, and I have an entry sell price, a stop loss, and a bearish limit that I can look to target, depending on where this market goes. Okay, that's just silly. My bearish limit label just disappeared. Okay, I've got one for each direction. I would look to set this up, and again, we're going to cover this in more detail in the next segment when we come back, but I would look to set this up as an OCO, right? So whichever one gets triggered first, that's the one that I'm looking to trade. I'm not going to have these set up, although it is permissible per the rules. You can set this up as a standalone entry buy stop with its stop loss and limit, and a standalone entry sell stop with its stop loss and limit, and have them both open and pending as a stop reverse, right? So if the market breaks out in one direction, in this case it broke out in the direction of the bears, right? My entry sell position is triggered, and I'm naturally in the sell. I'm looking to go for this limit target. If I set it up as two separate standalone orders, then I have a stop reverse. If the market were to come back into the consolidation range and stop out my sell position, I'll immediately be taken into a bullish position, right? Or vice versa. You can do that because the Ultimate Traders Package teaches us that if the market breaks out of a consolidation range and returns back into that range with a fundamental announcement, more than likely it's going to break out in the opposite direction. For me personally, I'm just kind of a one and done kind of guy, right? So if the market takes me in and I'm in the position, capturing profit, all of a sudden the market turns around, stops me out, that's it. I'm not interested in chasing the market in any way, shape, or form, right? Usually when it comes to fundamental announcements, we're expecting very aggressive movement in one direction or the other. That's what we're looking to trade. Any questions on how fundamental announcement trading works? This is the preliminary discussion. We're going to get into this in very thorough detail in the next segment. But does everyone get this concept? Talk about setting up the entries, different ways to set this up when we return. Okay, perfect, perfect, perfect. So, excellent. Everyone is now clear on the different ways to be able to trade fundamentals, to be able to identify consolidation, which was the goal of this segment. So make sure that you kind of think about this a little bit while we're on the break. When we come back, we're going to be talking about the big kahuna. We're going to talk about non-farm payrolls and the unemployment situation for the United States when we return. This has been Will Gomez. I'll see you all at 10:30 p.m. Eastern Time.